we should talk about like the money behind this, because if you're eligible for that disability tax credit and you don't open an RDSP, you are leaving so much money on the table.
Welcome to Money Talks Life Lessons. My name is Melissa McGuire. I am the co-host of this fabulous podcast and co-founder of Isle Wealth with Raymond James. I am joined here today, as usual, with my co-host, Joanne Caban.
Hi, everyone.
Today, we're going to delve into the Registered Disability Savings Plans, otherwise known as RDSPs. We're going to talk about how they work, how they fit into an overall financial plan, and what are they? And again, some of the rules that come along with them.
Yeah, they're one of the most powerful tools out there for people with disabilities, but so many families still don't know much information about them. So I think today will be really exciting for us to talk a little bit more about what a registered disability savings plan is and how, if you're eligible, what a life-changing alternative it can be for savings, and it can probably take a lot of worries, or give you a lot of peace of mind when it comes to planning for a loved one's future.
Right. So why do you think that so many families don't know about them or don't fully understand how valuable they can be to a family future in estate planning?
Well, first of all, in order to be able to have a registered disability savings plan, you need to be eligible for the disability tax credit, which the process, if any of you have ever gone through it, is quite lengthy.
And daunting.
Yeah. There's a lot of information that it takes to fill out the forms. You have to give a lot of history on certain things. There's different requirements. So a lot of people don't even bother going down that road because it can be too overwhelming in the first place.
Yeah, you need a doctor to help you with it. And the thing I find about those forms, like the application form for the disability tax credit, is that generally the form is all about what you can't do. And in life, we all like to think more about what we can do.
Right.
And I find that can be really difficult for some people to work through.
Yeah, 100%. And I mean, for a lot of people who might need this type of program, they're already going through a lot at the time. It might be navigating children in a school system, and there's already a lot of other things you have to think about, right? There might be medical issues that arise, so that becomes top of mind. So financial planning often becomes kind of a back seat on those sort of things. And, to be quite honest, a lot of financial institutions don't even bother talking about RDSPs. And in a lot of situations, financial institutions don't even talk about RDSPs. So unless you already know it exists, you're not going to apply for a disability tax credit to get one open. You don't know what you don't know.
Right. And certain levels of different financial institutions don't offer them at all. Right? Like they might be like, okay, at the basic branch level, we don't offer this, but you could do it through, this platform, but you do it yourself, right? That's it. These are programs that need a lot of guidance to start and might need a lot of guidance for, the duration of the time you have the plan, and to sort of be left on your own with them could be pretty tough.
Yeah, exactly.
Why do you think it's important to look at the RDSP not as a standalone account, but as part of a broader financial plan?
So the RDSP is part of everyone's larger financial picture because it touches every aspect of it, right? So it's important to know your tax situation when it comes to it. There's tax deferred growth within the plan. By saving within the RDSP, if you're receiving government benefits for the disability, it doesn't go against anything that's income or asset tested. So it allows you to still be eligible for government benefits that might have limitations on it. There's also estate planning benefits for it as well.
I find too that there are a lot of rules to the RDSP that we're going to talk about shortly, and some of them can be prohibitive to spending. So the RDSP shouldn't be the only avenue, but it is probably the one that should be front and center, and then everything else as a complement when we consider just actual accounts.
Right. And most of the time we view the Registered Disability Savings Plan as more of a retirement longer term planning.
Right.
Just to your point, because there is limitations, which we are going to talk about today.
Right.
And certain rules that we have to follow. So hopefully this is really helpful for everyone listening today and can bring some clarification on what this is all about.
Right.
All right. So let's start with the basics. You have dealt with a lot of RDSPs in your career. What exactly is a registered disability savings plan, or RDSP?
It is a retirement plan for people who qualify for the disability tax credit. An RDSP allows people to save into the plan and get government benefits as well in terms of grants and bonds. It is a long-term savings plan designed to help facilitate the savings, because the government helps with grants and bonds and stuff based off of your income testing and whatever. But it is a long-term plan meant to help people later on that maybe are slightly disadvantaged now and not able to funnel money into their RSPs at the time if they had RSPs, right? So the RDSP then allows later on for the withdrawal of income that's taxed differently than a regular RSP or RIF plan would be.
The first step to opening an RDSP, or a registered disability savings plan in Canada, is you need to have the disability tax credit, like we talked about, right? Yeah. So, but once you get that approval, so you get that piece of paper in your hand that says you are approved, the next major item that you need to be aware of is you must be a Canadian resident and you must have a social insurance number, because if we don't have those three things, we can't open an account for you.
Right.
Okay, so now that we've talked about what we need to open the RDSP, who is going to be the plan holder and who would be the beneficiary in this case?
Oh, well, I mean, you can be a plan holder and a beneficiary all at once if you have minor children, or you have, or you are caring for somebody who doesn't have capacity to hold the plan themselves. Then you can be the plan holder, and the beneficiary is always the recipient of the disability tax credit. So you can do it your own self. You can do it if you're a parent with a child that collects a disability tax credit. You can open it for them. If you are a guardian for somebody who collects a disability tax credit, you can open it for them. But again, the beneficiary is always going to be the recipient of the tax credit. I guess we sort of talked about this a little bit, but there's some intricacies here. So how does the Registered Disability Savings Plan compare to other registered plans, like the Registered Retirement Savings Plan, or like the Registered Education Savings Plan?
Yeah, so I mean, registered retirement savings plans are specifically for retirement, where the RESP, the Registered Education Savings Plans, are for education. The RDSP is kind of unique, right? With an RDSP, you don't get a tax deduction like you would with a registered retirement savings plan. With that account, you put money in, you get a tax deduction on your income tax return. That doesn't happen with the RDSP. But what you do get is amazing government grants and bonds, which is not what happens within the RRSP.
Right.
However, if anybody's familiar with the Registered Education Savings Plan, that is something you do get some grants from the government towards schooling, but they're not nearly as generous as this plan.
Yeah. I find that for the two, like if we were, the RRSP seems to be very, very flexible, right? Like in terms of you put your own money into the plan, you don't get anything extra, right? Of course, there's that tax benefit, but then withdrawing from the plan and all that sort of stuff, it's kind of like loosey-goosey. You do it as you need to, knowing that you're going to have some taxable events if you withdraw from it and all that sort of stuff. But there aren't any rules around that, around withdrawing. Rules around tax, of course, but not around withdrawing. But for the RDSP and the RESP, Registered Disability Savings Plan, and the Registered Education Savings Plan, there's all sorts of rules on withdrawing. And they both involve the loss of government grants if you don't do it right or do it for the wrong reason. So sometimes they're a little bit more similar than some would think.
Yeah, that's a great point to add. So who can contribute to the RDSP? Do you see the beneficiary doing it? Is it usually the plan? Like if it's different from the plan holder, who can make these contributions to the account?
So let's say we're looking at a regular scenario where there is, I mean, it's not so regular, but let's just say we're looking at a scenario where there is a parent that's contributing to the plan for a minor, right? Not that they're not capable of holding the plan on their own just yet, but they're just a minor, right? In that case, it's going to be the parent contributing, right? Sometimes what we do see is there is maybe a capacity issue for holding the plan. So it is a parent that's holding the plan or the guardian, but it's still the beneficiary that's contributing to the plan. Right, they're still saving their own money into the plan, or it is the guardian or the holder, whoever that is, that's making the contributions.
Right.
So it is very flexible in terms of who can be contributing to it, but they have to be like listed somehow with the plan to make those contributions.
Right. Yeah. Okay, that makes a lot of sense. And I mean, one of the things that people often ask us are there any limits, like annual limits, lifetime limits for this? And I guess, long story short, there are no annual limits. Like people can come and go as they please, but there's a lifetime maximum of 200,000 that any one person can contribute.
Yeah, and you could think though that there might be annual limits in terms of the grants that you could collect.
Yeah, like
right?
the eligibility to get the full
exactly.
grant.
So there's a certain amount. Everybody gets a statement. They get a letter that says what they're eligible for that year, and then if you contribute that, then you're going to get the grants associated with that contribution, and then that's it for that year for grants and bonds for that year. But you can contribute to the plan continuously as long as, you noted, you don't reach that $200,000 cap.
Right.
So, and we need to be pretty careful with that because we want to be able to maximize the grants and bonds that come along with it. And we don't want to, put the plans in jeopardy. Sometimes it's just a matter of a little bit of math or doing things at the right time to make sure we're still going to get the grants, right? Like say you had, I don't know, you suddenly have a lump sum amount of money, or you're on the cusp and you know that if you make a contribution of like $500 a month to this plan and you very quickly exceed 1 year's grant allowance, and then you're coming to the next year where you're reaching your $200,000 contribution limit, we'd want to really stagger those contributions so that we know we're going to get the contributions for that first year and the contributions for the second before you reach that $200,000 limit.
Okay, that makes a lot of sense. Okay. And I guess it really helps to work with a professional that could kind of walk you through how those calculations would work. Often we have clients who, qualify for the disability tax credit. They come into our offices and they're wanting to figure out, okay, well, we hear these magical times that we really need to pay attention to. So they'll often bring up age 49 and age 59 and saying, okay, well, why are these ages so important for the beneficiary? And generally speaking, when it comes to contributions can technically be made up into the age of 59, before they turn 59. But then there's issues with what they get for grant eligibility and things like that. So in theory, you can contribute up until you turn 59, but at that point, it converts to where you're now supposed to be taking income from it, right?
Right.
And so can you maybe explain why being 49, that age, is so important for people who have an RDSP?
Well, earlier I talked about the RESPs, right?
Right.
Rules on withdrawing from the plans and how you have to do it in a certain way or you lose your grant eligibility. It makes a lot of sense when you think about it from the perspective of a registered education savings plan. So our registered disability savings plans, you will continue to get those grants based and bonds based off of your contributions. Even if you are contributing past 59, they stop at age 49 because those grants and bonds need to be in place for 10 years prior to when you start making those withdrawals. So if you're contributing from age 49 to 59, as you noted, it's just your own contributions, whatever you're putting into the plan. And then once you start withdrawing at age 60, then you've had 10 years of those grants and bonds to mature. If you withdraw prior to that, you're going to lose some of your grants and bonds and the fabulousness of the plan.
Yeah, and in saying that, what if I was doing it on my own, I didn't have the guidance of an advisor, and I missed some contributions, right? How does catch up work? Playing catch up?
Well, you can catch up a couple years at a time. But if you want to catch up for longer periods of time, you have to apply to do that.
Right.
So if, for example, let's say age 49 is when you actually suddenly think about opening up.
And we've had clients like that.
And you open it up at age 49 to get an RDSP, and you have been eligible for the past 10 years because you've had the disability tax credit for that whole time. Right? You can make your contributions and you can catch up 2 years at a time. But if you made an application to the government to retroactively apply for those grants and bonds for the past 10 years and they approve it, then after age 49, you've got the full balance of those grants and bonds in that account that you just can't touch yet for another 10 years but you could. It's a process, it's an application, and it's not easy to do that.
But it's worth it.
But it's absolutely worth it. Yeah.
Yeah, and on that front, we should talk about like the money behind this, because if you're eligible for that disability tax credit and you don't open an RDSP, you are leaving so much money on the table from the government.
Yeah. Can you walk us through how the Canada Disability Savings Grant works?
Yeah, I mean, so the government matches contributions at a 300%, 200%, or 100% rate, depending on your family's income and the contribution size, right? So grants can go up to about $3,500 a year, with a lifetime maximum of $70,000 per beneficiary.
Right.
That's huge. So if you think about it, like in a lot of our client situations, like they'll put in $1,500 a year and the government gives them $3,500.
Yeah.
So that $1,500 deposit automatically becomes now up to $5,000 just for that contribution.
Yeah. And
Huge.
that's just the grant, not the bond.
Exactly.
Like, that's amazing.
So I was talking about the 300, 200, 100% depending on income. Can you elaborate on how your income affects these rates?
That's the really important part to note, because a lot of people don't realize that the RDSP like grants are income tested.
Right.
Right. So it is, lower income families do get the higher match. So there's a formula. So it is, for the lower income families, 300% is matched on the first $500 contributed and 200% on the next 1,000. That's a heck of a lot, right? For higher income families, you just receive a straight 100% match on the first $1,000 contributed. So it is definitely income tested. And in this case, I think it's an excellent benefit for people who may not otherwise be able to make the contributions that maybe a higher earning income family might be able to.
You know what? That just sparks something in my mind here, because often when we were talking about who's the plan holder and who's the beneficiary, this is where this is really, really important to get right. Because you might have parents like myself who have opened up this type of account and then their child turns 18 and they're like, I want to just hold on to the account and still have control over it. But guess what? Your grant eligibility and the bonds are based on the plan holder's income level, right?
Yeah.
So generally, if you have a younger person, 18 or so on, they're not in the same tax bracket. As the parent.
Exactly.
So by switching the plan holder name to the child instead of the parent, they could be eligible for that 300% instead of being maybe brought back to that 100% match.
Exactly.
Yeah.
It's very, I think we've said this before in a different podcast, but it's one of those like extremely nuanced things. So when people are looking to open a registered disability savings plan, it is really important that either they read everything and figure it out, or work with a place that can give the guidance and all of those little intricacies, so you can maximize, right? So we've talked about the grants. Now let's talk about the Canada Disability Savings Bond. What's that all about, and who qualifies for that?
Yeah, so that one is for low income households. There's actually no contribution required.
Right.
So you can get up to $1,000 per year for not even putting any money into the account, up to a maximum of $20,000.
Right.
So for me, it's like I look at this as a no-brainer to get the account open, because if you qualify for this, that's $20,000 that you get free.
Yeah, it's
Huge.
wild, hey? So from a $1,500 contribution to suddenly $21,500 in the account, like it's pretty amazing to see how quickly they can grow.
So once money is actually in the RDSP, so we've got this magic $5,000. I'm going to pick on that. So you opened an RDSP, we put the $1,500 in, your account's now worth $5,000 because the government gave you $3,500.
Right.
What do you do now that money's in that account? Can you invest it? Can it be in like, is it in cash? Like, how does this all work?
You know what? This is probably one of the most tricky questions to answer. Because although there might be acknowledgement on the Government of Canada website about all that you can do, sometimes it's very specific to the institution or the holder of the investment on what you can do. So technically you can do anything that you would do practically in an RSP or like a TFSA, any sort of other investing vehicle, right? You can hold cash, you can hold bonds, you can hold equities, whatever, as long as you are working within your own risk tolerance or the risk tolerance of the holder. But it is very institutional specific. Mm-hmm. So, for example, in Canada, BMO and Mackenzie are the two largest RDSP suppliers, right? And there's some very specific rules for each institution and holding those investments, how somebody could. For example, if let's say you had a Mackenzie investment with an institution, like let's say I'm going to call it the Bank of Joanne. So
I like that.
The Bank of Joanne is offering you to hold the RDSP platform, right? Mm-hmm. So I go to the Bank of Joanne, I say I'd like an RDSP, and the Bank of Joanne says, absolutely, you can have one. We're going to hold it with Mackenzie, just to pick on a company. We're going to hold it with Mackenzie. We're going to do it this way. The Bank of Joanne is very clear on what the rules are allowed by holding that money with Mackenzie. And maybe those rules don't always coordinate with what the rules are on the Bank of Canada website, but it's what the institution allows as well.
Right.
So that's a really, really important distinction to make, because technically you can invest in pretty much the same type of stuff. If you're using certain like BMO or Mackenzie, you stick within a certain risk tolerance. You can't do Bitcoin. You can't do something like that within the RDSP, but you just have to be mindful of the institution and their rules.
Right. And I think, we've had barriers like this come up in client conversations where they want to hold stocks.
Yeah.
But a lot of the institutions won't allow it, right?
Exactly.
And I think the rationale behind that when we asked was because the RDSP is meant to be a retirement or an income replacement for individuals that are, already kind of compromised in some way. And we need to make sure that we're not putting them at more risk in terms of supporting their future.
Right. And it's important to note that that's an institutional rule. So it's just important that we acknowledge that there might be some differences based off of the institutional rules.
Right.
Yeah. So sort of in keeping with this vein, how should time horizon and risk tolerance influence the investing strategy, do you think?
Well, I guess it depends on how many years this is going to be in place for. There's some situations where this account could be open for 60 plus years. In all honesty, if you're eligible for the disability tax credit when you're, under 10 even, right? You could be eligible for that. So you might have it for a long, long time. So depending on your time horizon, we generally do like what we would for RSPs or any other investments. We would do a mix of, equities, so stock market exposed investments, and we'd have some fixed income and some cash to provide safety. It really depends on how long we have until they might need that income and what the comfort level is of the people controlling the money.
Right. So it's a typical risk sort of conversation that we have with the plan holder.
And similar to that of RESPs or even RRSPs, as we get closer to when we're going to need to access the money, we're going to adjust the risk, right? So it's not a one size fits all. It's going to be, specific to the individuals we're looking after. Okay, so how and when can money start being taken out? I know we talked about age 49 and 59. So can you elaborate a little bit on this for our listeners?
Okay. Yeah. And this is really important, right? As we've noted before, if you take money out of the plans too early, you lose some of your grant and bond eligibility, right? The government will just take it right back. So mandatory annual payments must be made from the plan by the end of the year the beneficiary turns age 60. So I'll just say it one more time. By the end of the year, the beneficiary turns age 60. There are two types of categories that the withdrawals fall into. So we call it the disability assistance plan, otherwise called DAPs. And those are sort of one-off payments that people might need. And then there's a lifetime disability assistance payments. So those are the mandatory payments that come out of the plan.
Would that be kind of like a RIF then? Like, when you turn 71 and then you start taking payment at 72, it gets paid to you annually at a specific amount.
Yeah, but it must be done. So with a RIF, like we must convert it to a registered retirement income fund by the end of the year. The annuitant is 71 and the payments must come out by the end of the year. They're 72. With an RDSP, everything is age 60. So the plan holder the beneficiary must receive that payment by the end of the year that they're 60 years old. There isn't the grace to go into age 61.
Perfect.
Okay. So we're talking about the withdrawals and how they come out. So How are they taxed? Are they taxed in the hands of the beneficiary?
Yeah, so they are taxed in the hands of the beneficiary, and they're tax-free on the contributions going in.
Right.
Okay.
Which is very different from the retirement income funds.
Yeah, which is everything's taxed
Yeah.
on the way out, right? But the government grants, bonds, and any growth, any investment growths are taxed in the hands of the beneficiary. But generally, those individuals are going to be in a lower tax bracket.
Right.
So tax is going to be probably minimal for them.
Right. So it is, it's more, these plans definitely have more similarities to the RESPs, hey, the Registered Education Savings Grants, because it's the same way, like growth and grants are taxable in the hands of the beneficiaries too.
And usually when people are taking them out, it's when they're in a lower tax bracket as well.
Exactly.
So it makes the most sense from that standpoint.
Yeah.
Now, how does RDSPs affect provincial disability benefits? So if you're getting help from the government.
It doesn't.
Oh, I love that answer.
The short answer, and one of the most wonderful things about these plans, like yes, there is a taxable component to the grants and bonds and income that's in the account, but that income doesn't affect provincial disability benefits, which is just
huge.
amazing. It's absolutely enormous.
Yeah, we spend a lot of time, doing estate planning for a lot of families. And when there's disability benefits from the government involved, like sometimes we have to be really creative on how we're going to, leave money to the next generation if they're eligible for these benefits. And it's nice to know that could be part of the factor. Like we could be saying, which we do, to a lot of our clients, hey, funnel some money into the RDSP because it's not going to prevent them from getting like whoever you're leaving the money to, their disability benefits. That's huge.
Right. Yeah, it is enormous. And it's got quite a significant lifetime benefit to or lifetime contribution limit as well, right? So it's not a small amount of money that you can contribute. Okay,
Mel, so I know we just talked about how we're planning to make sure that our clients don't get disadvantaged when it comes to their government benefits. Can you elaborate on that a little bit and how we should kind of prioritize funding money that we're leaving to the next generation if they have a disability?
Well, it goes back to sort of the financial planning aspect of things, right? Whenever we're financial planning, we touch on all aspects of somebody's sort of financial life and their goals. The RDSP, if somebody has one, will obviously be sort of the front and center idea for us, understanding the limitations that come with contributions. But we do also have to consider outside savings because the RDSPs come with limits and rules on withdrawing, and you can only withdraw from age 60 and beyond without any negative impact. It's always nice to have other sort of aspects of like financial availability or option, right? So like it doesn't, having the RDSP does not underscore the importance of having a tax-free savings account or a non-registered account or something to that effect. But we always have to be mindful of the $100,000 asset size limit, right? That's a very, very big deal. So,
and where does that come from?
That's the provincial benefit rule, right? If anybody's receiving disability provincial benefits and they have asset sizes of higher than $100,000, then they can have some real difficulties with the amount of provincial benefits they receive. Sometimes it impacts housing wherever they may be. Like maybe somebody's in a low-income housing scenario collecting a provincial disability, and then they suddenly receive this very large inheritance. That inheritance, which might only get them a year and a bit of like living, will pop them out of their low-income housing things, pop them out of their eligibility for the provincial benefits, and just leave them with a year and a half of maybe income, just as an example.
Well, yeah, and we've actually had a few situations like this where clients have come in with an inheritance and there wasn't proper estate planning done ahead of the time, and we've had to rush and open them up, Henson Disability Trusts, right? In order to make sure the money moves quick enough that it's not going to impact their housing. Because we actually had a client who almost got displaced because of that exact situation, right?
Yeah, exactly.
So if any of you listening, have a child or a dependent that you're going to leave money to that is eligible for that disability tax credit, is on disability benefits, it's really important to structure your estate in a certain way if you're going to leave them money that doesn't push them over that asset tested level.
And that's always like, that's a really tricky conversation to have or a thought to have, because oftentimes there's a very clear understanding of, what might happen 20 years down the road, right? In terms of an RDSP beneficiary's ability to work or do the stuff, right? Sometimes that's very clear and the understanding is very much there. And that's an easier sort of plan to make for the future, as opposed to somebody who maybe they just don't know where they're going to sit 20 years from now. And it's not unusual for people to be questioning and wondering and thinking about it for a while before they sort of settle out their estate planning when considering sort of lump sum inheritances and such. Because it's a tough thing to plan now for a future that you don't know what's going to look like.
Yes.
But it is definitely a question that everybody needs to ask or talk about.
Yeah, and I think the RDSP can provide a lot of peace of mind and certainty for people who are wanting to make sure their kids are going to be looked after, or that dependent is going to be looked after they're gone, because at least this is not going to impact their government benefits and they can have income for life, right? Like for as long as the money's in the account, right? I shouldn't say income for life, but it's, as long as there's money in there and they're getting their monthly or annual stipend, it's protecting them.
Exactly.
I just went on to talk about a situation where we had to quickly open a trust, when somebody received more than that 100,000. And I alluded to a Henson Trust. Can you talk a little bit about what the Henson Trust is and how that would work, alongside the RDSP?
So Henson Trust is a qualified disability trust, right? So there's lots and lots of different types of trusts out there. In the legal world of finances, but this one is specific to the disability tax credit or having a disability, right? You still have to be eligible for the disability tax credit to hold the Henson Trust. So this trust, it is designed as a place to sort of shelter those assets for somebody who may be over the $100,000 rule in terms of assets. So that it's sheltered there and kept out of the personal name for the person with the disability. It has its own tax structure. It has its own thing, but it's designed to shelter the money and provide income to the person that is the beneficiary of that trust. But it is held by somewhere else. It's held by it's in a trust. So it's created as an actual real trust with an accountant and with a lawyer. And there is a trustee that manages this. So like an RDSP, you could be your plan holder and you can also be the beneficiary, right? With a trust, you cannot be the trustee and the beneficiary of a Henson Trust. Somebody else has to be involved.
Yeah, and I think that that's really good that you pointed that out, because a lot of the times when there's money being left as an inheritance, they want to make sure that the money is set out for a very specific reason for that individual that's left behind. And sometimes they don't have the capacity to be able to manage that money.
Right.
And so it's great because it takes all of that off the table. And there's a trustee who is really looking after all the affairs and making sure that individual is taken care of,
right,
to the best of their wishes. So they're being able to have a little bit of control on that.
Right. And that's a tricky thing too, because the trustee can be anybody. Right.
Right.
That let's just say it comes from an inheritance. And so you'd want, it's part of the estate planning. And oftentimes people will say, well, how'd the sibling do it? Right. The sibling will be the trustee for the other sibling. Those are very serious conversations that you need to have when you are appointing somebody as a trustee for maybe a sibling or somebody close to them, because you're managing their finances for you're agreeing to do that in perpetuity. Right. So it's always a really important consideration when you're looking at something like a Henson Trust, understanding exactly what it's there for, and then making sure that you appoint the right person, because it sometimes can be tough for a sibling relationship or a close relationship if suddenly somebody then has control over all the money, right? And so sometimes we had a previous episode where we talked about trust services, right? Sometimes you can use a corporate trustee service or something, allocating somebody for this position. And I think that is the most important part, is allocating a trust service to do it, or somebody that knows what they're getting into when they do that, as opposed to just sort of leaving it up to a guardian, like a public guardian or something to that effect.
Yeah, exactly. And there's nothing worse than having to go and tell your sibling, no, you can't have access to your money, right?
Yeah.
That's a hard conversation to have. If you're put in that position, it's best to kind of remove yourself altogether if you can.
If you can, yeah.
Yeah. And so one of the really cool things is that I just want to mention as well is that parents and grandparents can actually appoint an RDSP as and leave money directly into it for that beneficiary as well.
Yeah.
So that can be something that's done in the estate planning process.
Yeah.
So what are the most common planning mistakes you see around RDSPs and estates?
Well, for the RDSP, usually it's a misunderstanding of the eligibility of the government benefits. Those are sort of the biggest difficulties. I also find, and I consider this to sometimes be a common, I don't want to say it's a mistake, but the one thing that I find to be very important that we oftentimes might not see is, people bringing someone with them when it comes to like opening an RDSP or understanding the rules of the RDSP. 2 sets of ears are always better than one. And sometimes it takes 2 people to understand, what this looks like for somebody that is a beneficiary of the plan. It's not a common mistake, but it's something I think I wish was more common when it came to opening up the plans. Generally, it's a misunderstanding of the grants. It's a misunderstanding of the savings. Because again, once you reach that annual limit, you could still save into that all you want, but you aren't going to get any more grants.
Right.
And so that might be tricky for some people.
And I think we talked about this at the beginning, just not applying for the disability tax credit in the first place and not even getting the plan started.
Yeah,
We're leaving so much.
We'll call that the number one mistake.
Yeah. So much money on the table if we just don't start the process.
Yeah.
So in saying that, like, what happens if we do wait too long to apply for the disability tax credit?
Let's just think about it from the RDSP perspective first, right? So we know the benefits, the grants, the bonds are income tested. If you have a disability and your income starts to increase, the possibility of getting more and more grants is going to decrease a little bit as your income increases, right? So from a financial perspective, first, if you wait too long to get the disability tax credit, you might not be able to be eligible for the RDSP in the first place. Like if you wait till you're 50 years old, well, then there's a problem, right? But if you know you're going to be down that road and you're starting to like maybe get better from whatever, maybe you have a temporary disability that did qualify for a disability tax credit, and then you start sort of on the path to healing and working and doing whatever, then you might see a financial difficulty there. Also, though, sometimes that disability tax credit benefit can go back for quite some time, right? And that's a whole different taxation question outside of even just the RDSP of what could happen for your taxes and all that from there. But it does allow for some additional room sometimes if you apply for it at the right time in your RDSP. So if you are eligible for the disability tax credit, then we should be hopping on it right away.
Right. And we've seen that like ourselves quite a bit where someone gets the tax credit and it goes back to birth. Right. And then they can go through that process of playing catch up.
Yeah, exactly. Yeah. The tough part is when you get somebody who should have been able to apply for it quite some time ago and then finally does, and then they're declined because they've been able to do the stuff, right? And then they're declined for it. And you're like, oh, darn. I mean, and just so everybody does know, our listeners do know, even if you are declined for the disability tax credit, it doesn't mean that you don't have the ability to go back and appeal that decision.
We've had so many clients that have to do it 3 times and then they get approved.
Yeah, exactly.
So if we want our listeners to remember 3 things today, what should they be?
Open one. Don't leave all that money on the table. Open one. Just know that the institution that you work with is going to play a pivotal role in what this looks like for you once you open one. And just be mindful of I would say, understanding how the grants and the bonds work.
And it's one of the richest programs the government's funds in Canada. So let's take advantage of that money. Time is money.
Yeah. There you go. Thanks so much for watching our episode about the registered disability savings accounts. If you've been sitting on the fence about applying for the disability tax credit, the time is now.
And if you have any questions when it comes to opening or managing a registered disability savings plan, feel free to reach out to your advisor. Melissa and I are always here to help. You can check us out on our website, islewealth.ca, follow us on Spotify, or subscribe on YouTube.
Thanks so much.
Bye for now.
Corporate disclaimer. This podcast has been prepared by and with expressed opinions of Joanne Cabin and Melissa McGuire, and are not necessarily the opinions of Raymond James Ltd., RJL. Statistics, data, and other information presented are from sources RGL believes to be reliable, but their accuracy cannot be guaranteed. This podcast is for informational purposes only and should not be construed as an offer or solicitation for the sale or purchase of securities. Investors considering any investment should consult their investment advisor to ensure that it is suitable for the investor's circumstances and risk tolerance before making an investment decision. Past performance is no guarantee of future results. Information provided in this podcast is general in nature and should not be construed as providing legal, accounting, and/or tax advice. Should viewers have any specific questions and/or issues in these areas, please consult a legal, tax, and/or accounting advisor. RJL is a member of the Canadian Investor Protection Fund. Raymond James USA Ltd. advisors may only conduct business with residents of the states and/or jurisdictions in which they are properly registered. Raymond James USA Limited is a member of FINRA and SIPC. We hope you enjoyed the podcast, and for more information, please visit islewealth.ca.